Leah closes the register at her home goods shop. Sales look normal, but the back room feels heavier than the bank account. On paper, she had a decent month. In boxes, she had $18,000 trapped in candles, planters, and winter throws. That is today's signal. Sales can stand still while inventory quietly eats the cash you thought you had available. Leah was not failing. Customers still came in. The problem was that yesterday's buying decisions were now competing with payroll. Every founder knows this feeling. The store looks full, the checking account looks thin, and the spreadsheet does not explain the ache. The goal is not to panic. It is to separate healthy stock from cash traps before automatic reorders make the pile larger. Leah's turning point came when she stopped asking, "What sold?" She asked, "What cash is still waiting to become useful again?" So we are building a backroom cash map. Not fancy. 1 page, 4 columns, and 30 honest minutes with your inventory. Start with categories if SKUs feel overwhelming: candles, apparel, parts, gift items, packaged food, raw materials. Smaller beats perfect. For each category, write ending inventory dollars divided by last month's sales dollars. That is your local inventory to sales ratio. The public retail signal is calm, not sleepy. Fred's census-sourced retail inventory to sales ratio showed May 2026 at 1.25. Wholesale improved too. The census-sourced wholesale inventory to sales ratio was 1.15 in May, down from 1.19 in April. Manufacturing also eased. May inventories were about $962 billion, shipments about $653 billion, with a 1.47 ratio. But lenders are asking sharper questions. The April Federal Reserve survey reported tighter business lending standards and tighter collateral requirements for firms of all sizes. Inventory turnover benchmarks vary by category. Shopify cites retail turnover near 10.86, while Investopedia recommends comparing against your own history. That matters because Leah's candles were not bad inventory. They were just too much inventory for the speed of customer demand. A high ratio is a warning light, not a verdict. Seasonal buying, supplier delays, and deliberate buffers can all raise it. Leah learned that the question is not, "Is this number good?" The question is, "What changed, and can I explain it?" Here's the first pass. Circle categories where sales are flat but inventory dollars are rising. That combination deserves attention. Then mark the age: fresh, on plan, late, or stale. Age tells you whether patience is strategy or avoidance. Pause. Leah found 6 cartons of winter throws purchased because last year sold out. This year, warm weather arrived early. That is not a character flaw. It is the normal cost of forecasting with imperfect information and a supplier minimum order. Now add 4 labels to each category: turnover drag, reorder urgency, markdown clock, and lender haircut risk. Turnover drag means cash is parked longer than planned. If the item moves slowly and ties up dollars, it gets a closer look. Reorder urgency is the opposite. If sell-through is strong and lead time is reliable, you may need to protect availability. Markdown clock asks when slow stock becomes more expensive to hold than to sell at a smaller margin. Inventory turnover uses cost of goods sold divided by average inventory. Days on hand is roughly 365 divided by turnover. Leah picked one planter line. Average inventory was $4,000. Monthly cost of goods sold was $800. Using the standard formula, that planter line turned about 2.4 times annually, implying roughly 152 days on hand. Maybe that is fine for artisan goods. Maybe it is not. The comparison should be against Leah's plan, margin, and shelf space. Next, calculate reorder point for your healthy sellers, average daily unit sales time, supplier lead time, plus safety stock. Do not use reorder points for items already drowning you. Automation can turn a small forecasting mistake into a monthly cash leak. Leah found one setting in her point-of-sale system that reordered candles whenever stock dipped below an old threshold. She paused that rule for the slow-scent families but kept reorders active for the small jars selling every weekend. That is the discipline. Do not punish the whole category. Split the winners from the passengers riding in the same box. For green zone SKUs, consider reordering normally. For yellow zone SKUs, reduce quantity or ask for smaller packs. For red zone SKUs, stop automatic reorders, set a markdown date, and decide whether the supplier relationship needs renegotiation. Leah called her candle supplier. Not angry. Prepared. She asked about smaller minimums, mixed cases, and slower shipping cadence. Supplier renegotiation often works better when you bring sell-through evidence. Vendors may prefer smaller repeat orders to one oversized mistake. Try this sentence. I want to keep buying, but current velocity supports smaller lots. What flexible options do we have? Now, markdowns. This is where founders get tender because a markdown can feel like confessing you guessed wrong. But a planned markdown is not defeat. It is converting stuck inventory into oxygen before rent, payroll, or taxes demand it. One approach, review at 30 days past plan, stronger offer at 60. Exit decision at 90, unless seasonality truly justifies holding. Seasonal owners, do not apply this blindly. A Halloween shop, garden center, or ski rental counter needs a different rhythm. The test is whether the future sales window is real, close, and large enough to justify the cash being parked. Leah kept the winter throws, but moved them into a planned holiday bundle. The plan had a date, margin, and display location. For items with no clear window, consider bundling. Local partnership sales, online clearance, or donating when tax guidance supports it. Run donation or write-off choices by your tax professional. The cash, tax, and brand effects can differ by situation. Then comes the lender question. Inventory appears as an asset, but not all assets turn into cash with the same confidence. The Federal Reserve's April survey noted tighter collateralization requirements. That means quality, age, and resale value may matter more in credit conversations. A bank may treat fresh standard inventory differently from stale, specialized, personalized, or perishable stock. Results vary based on your business. Prepare a lender note before anyone asks. Current inventory value, aged inventory, expected markdowns, supplier terms, and realistic cash conversion plan. Hoftily. Leah's lender conversation changed when she stopped saying, "We have inventory," and started saying, "Here is what can move." This content is for educational and informational purposes only and does not constitute financial advice. Always consult with a qualified financial advisor or business consultant before making significant financial decisions. Here is your backroom check. Poll top categories by inventory dollars, not by what catches your eye on the shelf. Calculate inventory to sales for each one. Compare it with your trailing 3 months and last year's pattern before reacting. Flag anything rising while sales stay flat. That is where cash may be hiding in plain sight. Check age, margin, seasonality, supplier minimums, and lead time. One number starts the conversation. It should not finish it. Separate green, yellow, and red. Healthy stock gets protected. Questionable stock gets smaller orders. Stale stock gets a deadline. If this episode helps you catch one cash trap, share it with another owner. We all need fewer surprises. Leah's resolution was not dramatic. She paused 3 reorders, marked down 2 cents, and negotiated mixed cases for spring. The checking account did not magically transform. But the business stopped feeding cash into shelves that were already full. That is often what resilience looks like. Not one heroic move. A handful of small decisions made before pressure peaks. If you have 20 minutes today, pick one category. Run the ratio. Ask what changed. Decide one action. If you have an hour, build the whole cash map. Turnover drag. Reorder urgency. Markdown clock. Lender haircut risk. If your supplier is unreliable, keep buffer stock where history supports it. Just name the buffer, cost it, and review it monthly. If your product is perishable, move faster. Days on hand can become spoilage, refunds, and reputation damage before the spreadsheet catches up. If your product is custom, be careful with bulk buys. Specialized inventory may look valuable to you and discounted to everyone else. The decision rule is simple. Reorder what turns. Renegotiate what drags. Mark down what ages. Explain what a lender will question. Sales tell you customers still care. Inventory to sales tells you whether yesterday's bets are helping tomorrow's cash flow. Before the next supplier order, walk the back room. The warning sign may already be there, waiting to become spendable cash. Remember, this content is for informational purposes only and is not financial advice.